we're going to bring in Danielle DeMarco. Danielle DeMarco, she wasn't at our last seminar. Anyways, she is going to do her mortgage market update. And Danielle, as we've said before, she helps all of our investors not only get a mortgage, but develop a real estate investment plan so they can, put a mortgage product on one property and make sure that it doesn't affect their ability to put another one on the next property. So she works out all that out for you and takes the stress out of getting multiple properties when you're dealing with different lenders. So Danielle, we'll let you take it away here.
Thanks, Tim. Are you okay to move slides?
Yeah, I can change them for you.
Thanks. We'll go to the next one here. So, just to kind of touch on quickly, obviously, there's a Bank of Canada rate announcement coming this week. There's conversation between a quarter point to half a point drop. The job rate report came out just recently in the last few days here, which kind of led the banks to announce that they think it's going to be half a point. Having said that, that's not the only factor. So it'll be between a quarter and a half a point. I'm undecided on where I'm at on that, but hoping for half a point. Realistically, quarter to a half. So for anybody out there, one thing I always like to kind of explain is because it's a common misconception. Everybody gets hyped up over these Bank of Canada rate announcements, but really the rate announcements are the overnight lending rate, which affects the prime lending rate, which affects anybody in a variable rate mortgage only. So fixed rates are based on bond yields, and bond yields have been increasing the last 3, 4, 5 weeks. So we've actually seen fixed rates slowly increase over the last month or so. But the variable rate is where you're going to see if the Bank of Canada does drop, that's where we're going to see slower rates. So anybody who has a home equity line of credit or a variable rate mortgage, you're going to get a nice little dip in your interest rate, which means your payments should come down as a result of the rate announcement this week. So fingers crossed we get that half a point. Moving on, tonight's topic. So we wanted to touch on this. We've touched on this a few times before, but refinancing, like Tim and Azad said, 12.5%. We're looking at property values that are extremely high in Calgary right now, which, if you're a property owner, is a benefit to you. So one of the things that we kind of talk about doing is refinancing our property to take out equity. And so the higher the home value is, the more equity there is in the property, therefore the more we can pull out of the property. So, there's a few reasons we refinance. Reducing debt, which obviously helps us qualify for additional properties, pulling out equity to do down payment, which also helps us when we're purchasing to use that equity as your down payment if you don't have down payment saved up, or if we need to top it up. And then qualifying. So sometimes we refinance to extend out amortizations and maybe not access a ton of equity if there isn't a ton, but we can extend out amortization. So the first one I wanted to chat about is reducing debt. So to give you a rough idea, a home value of 500,000, you have a mortgage, a penalty, a lawyer, let's say consolidate a couple credit cards and a personal loan. Right now, without consolidating, you're over 3,500 a month. We take all that, put it into one mortgage, one payment over 30 years, we're 1985. That's over $1,500 a month savings. So when you're looking at from a budgeting perspective, if you've got multiple properties, looking at refinancing these properties, extending out amortizations, consolidating debt, lowering those payments, it helps on a monthly basis, which allows you to either put money towards other things, for example, saving up down payment, or purchasing, like Tim and Azad said, what is the reason you're buying real estate? What do you want out of this? So that extra $1,500 a month goes a long way for a lot of things. And that is using today's interest rates. That's, a fair conservative look at what you could be saving. Next slide, please, Tim. So refinancing to qualify. So just to kind of show you the same thing, if we have those same credit cards, things like that, we could spend a purchase price of 200,000 with 5% down. If we do that same refinance that we just talked about, consolidate those debts, extend those amortizations out, we can now purchase a $350,000 property with 5% down. So that's $150,000 of qualifying. We were able to consolidate debt, put people in a better monthly cash flow position for budgeting purposes, pull out some equity if we want. In this scenario, we didn't, and qualify. So now all of a sudden, that's an extra $150,000 of room you have to purchase the next property. That's the difference between buying something and not buying something, or condo and townhouse and single family home. So it's a really big difference when we look at qualifying. And the next slide, please, Tim. Thanks. So refinancing for profit. So this is where, if we're wanting to pull out some equity. So again, same property at 500,000, save a mortgage balance 275 coming up for renewal. This is a hot topic. There are 350 billion renewals coming up in the next couple of years here. It's huge. It's massive. It's the largest renewal years in Canadian history over the next couple of years. So the largest number of people coming up for mortgage renewal. People who are coming up for renewal, you were at 2.5%, 3%. Well, rates are now low 4% range. So they've come down a lot since last year, a ton since last year, but they're still higher than what you're paying currently. So if you just renew, sign on the dotted line at today's rates, keep your balance the same, keep your amortization at what the remaining amortization is, your payment is going up from 1565 in this example to 2322. That's a $700 a month increase in payment. Well, you were once cash flowing and now you're not. So what can we do to combat that? When you come up for renewal, your mortgage is up, which means your maturity is there, which means you can renegotiate everything and there's no penalty. We can look at taking that 15-year amortization remaining at renewal, extending it back out to 30 years. So if that's all we do, and we don't even take out extra money, and we just extend out amortizations on these investment properties or properties that you already own, you're looking at new payments. And again, these rates, this is 609. So that rate is last year's rate. So you can see right now, just to kind of jump off a topic for a second, this same refinance rate is about 4.5%. A year ago, it was 609. So you can see we have come down quite a bit in interest rates in the last year and a half. But again, like I said, still above where we were for people who are coming up for renewal. So your new payment is now 1652 instead of 1565 a month like it was before. Your rental income is still 1750. You're still in a positive position as compared with just signing on the dotted line and renewing. So it's a big deal. Amortizations are huge, and it's something we really, really use to our advantage when we're looking at qualifying and when we're looking at payments and cash flows. The goal when we're in a long-term hold, this is a long-term hold example, is to not necessarily pay your mortgage off as fast as possible. You've got a tenant in there, they're making the payments, they're covering your expenses. Let them, right? Let's let them do that. And you can keep extending that amortization out. It doesn't matter that you're paying more in interest. You're not the one paying the interest. Your tenants are the one paying the interest. But now you've got that positive cash flow, and that is going to help us qualify for the next property and multiple properties down the road. And next slide, please, Tim. Perfect. So those are the three different typical reasons that we refinance. So we refinance for qualifying, refinance for profit. We are refinancing to pull out equity for down payment. And I can tell you this year in 2024 is the most refinances I've seen. And I've been a mortgage broker for 17 years, 18 years coming up. So it's been a long time. And the reason for that is, again, property values are high, but also interest rates. Everybody that's coming up for renewal, payments are going up $600, $700, $800 a month, which just makes things not necessarily feasible. So again, even just adjusting amortizations or consolidating debt, there was a lot of layoffs during COVID, things like that. People want to catch up, get, back on track. This is a way to do it. So it's a great opportunity for everybody who owns a property to now be looking at those properties and figuring out, okay, should we be restructuring those? And if so, what should we be doing with them?
Hey, thanks a lot, Danielle.
Yeah.
Danielle's going to put her contact details in the chat for anybody who wants anything explained about interest rates or refinancing or, a new purchase. Like I said in the intro, she really, really goes above and beyond when she's helping out our clients. So reach out there. She'll put her contact info there. It is, or it's coming, and we'll keep going here.